Welcome back. And we will, I know everyone wants to network, and we're counting down the time for more wine, or actually starting the wine. I can use some, but we'll just have to wait till 5:30. So we've got two more panels coming up, two great panels, and this is the powerhouse panel, that's what I want to call it, because we have some heavy hitters here, female VCs. That's right. This, it is.
Women want to be called heavy, but
yeah.
But it's still. Right, exactly.
So rather than myself introducing them, I'm actually going to just have them introduce themselves as well, give everybody a sense of the fund size, your sweet spot. Actually, also just give them the sense of how old your firm is as well, and if you want, you could tell them what percentage of the startups you've invested in are female founders, since that's the theme here.
Excellent. So Rebecca Lynn, I'm a partner at Morgan Thaler Ventures. We've been around for over 40 years, and we just closed our newest fund, the Canvas Fund, and that's a $175 million fund. Thank you. With a focus on software and services, Series A and B. And there are three partners, myself and two Garys, and we are on the search for an additional partner in the fund. And I look heavily at women-founded companies, and I'm continuing to look. And actually just did fund a company that was co-founded by a woman called Convo.
We tried to get her here, I think.
We did.
We did. She couldn't make it.
She's away.
Okay, thanks. Hi, I'm Sharon Weinbar with Scale Venture Partners. We back early in revenue tech companies that are scaling. So typically small single digits, millions in revenue, doubling year on year. Every once in a while, we do a later stage company too. We've been in business since about 2000. We came in just a little bit before you, just raised our fourth fund that closed in, thank you, in May. It was a lot easier to raise money this time than our last fund, which closed in 2009.
Oh, much easier.
Yeah. Our firm has three of the 7 general partners are women. The CFO and all of her staff are women. We have a few women entrepreneurs, but not a lot. But we definitely have an open mind toward female-led institutions.
And Sharon, can you just mention the size of that fund?
Oh, sure. So we're a $300 million fund is the current fund. We don't have hard and fast rules about dollars invested or ownership stakes that we require. We're active investors. We take a board seat with every portfolio company, and we like to think that we do help the company scale. That's our big value proposition, is really helping drive growth.
Maha?
Hi, I'm Maha Ibrahim with Canaan Partners. We are a $3.5 billion fund. We recently, that is 18 months ago, closed our 9th fund. It's a $600 million fund, primarily dedicated to early stage investments. So about 2/3 of what we do is tech, 1/3 of what we do is healthcare, and again, early stage, so Series A, Series B is the sweet spot. We are a 26-year-old firm. We have 4 female investment professionals, myself and Wendy Hutton as general partners. Wendy is on the healthcare side, and I'm on the tech side. And I'm happy to say that out of our most recent fund, which is Canaan 9, about 1/3 of the investments that we've made so far have been founded by women. And I see 2 of them in the audience today, and I think you've actually heard from a couple of others this afternoon. So we've been really fortunate to attract some really amazing female founders and entrepreneurs.
And I was able to attract them to this event because Maha invited me to a dinner filled with female entrepreneurs, and I basically said, come to Amplify, come to Amplify, come to Amplify. So that's why they're big representation here from Canaan.
And thank you for that.
Hi there, Catherine Barr. I'm a general partner at Moore David Howe Ventures. We've been around since the early 80s. We're currently investing out of fund number 9, which is a $670 million fund. We invest across technology, cloud infrastructure to enterprise SaaS to web and mobile. We typically do Series A and B rounds, and I'm not sure anything else you want me to say?
No, I think your size of fund and your sweet spot and how old your firm is, I think we
covered it all. Great.
Okay, great. Well, this panel is about the future of venture capital and of course how venture capital is changing. So before we talk about the future, let's just look back a little bit and talk about what has changed. 2 key factors that's changed the venture capital business. One we know of, which is obvious, is that it's cheaper to start a business. So we know that. So two key factors that's changed the venture capital business in the last 10 years. Rebecca, we could start with you.
Yeah, absolutely. I think if you look back about 10 years ago, even 2000, 2001, it was very in vogue at that time to have billion-dollar funds, and everyone sort of had one. The Kaufman report came out and did the analysis that didn't work so well, right? So the funds that were the best returners were really $400 million and below. But what you're seeing today is really a polarization. You're seeing the brand name funds, sort of the top five, continue to raise those billion-dollar funds, and other funds continue to be more of a boutique sort of size, so with around the $400 million or less range. So I think that has really changed. And then the other thing is that we used to, and many people did, have a one big fund with, all kinds of different verticals within it. So life sciences, private equity, tech, all in one large fund. And what we've heard loud and clear from the LPs is they want to pick and choose, and so they want focused funds, right? And so you're seeing a lot of the older firms go that direction, and that's exactly what we did at Morgan Thaler, where we split out the life science group and the IT group into separate funds.
Yeah, so I would second that. And in fact, we had a similar history where we stopped life sciences investing a few years ago. But two things that have changed maybe in the technology landscape that are also changing how investors think about companies. One is just the incredible premium on growth in the public markets. And so it used to be, it used to be before Bubble 1.0 that you could take a company public with $20 million in revenue, and it would already be profitable, and it would do a $20, $25 million IPO. Now the public markets have consolidated down. The power curve of companies is very sharp because all the big companies have acquired the medium-sized companies, and they acquired the smaller companies. So it's very concentrated in the hands. The total market cap value is concentrated in a very small number of companies. And those companies are not growing that fast because they're pretty big companies. And so public stock investors are really looking for growth. And where it used to be that 30% was a huge growth rate for a company that was going public, now you're seeing companies try to pursue 100% year-on-year growth rate even into their IPO year and beyond, which means they're generally consuming a lot more cash. So even though it's cheaper to start a company, it's a lot more expensive to grow a company, partly because everything is more expensive, people and stuff like that, once you're out of I've built something on the lamp stack, but partly because the public stock markets are valuing that growth so much more, so it's worth it to keep spending on sales and marketing to keep the company growing. I think the other thing that's caused it to be relatively expensive to pursue being an independent technology company now is the markets are much more global and global earlier. So again, used to be that a software company could really pursue its craft in North America and 5 or 10 years later worry about going to, doing the FIGs, right? French, Italian, German, et cetera, and then later go to Asia. And now you have all these pockets of innovation all around the world where competitive startup companies are starting earlier in those other spaces. And so if a company really wants to have global commanding market share and they're starting in the US, they're forced to move overseas much faster, which just complicates life as a startup.
Just touching on, you're saying that startups, it takes a lot more money to expand. Well, you're in the expansion phase. Basically, that's what you come in, where you come in. So are you spending more money for your startups these days?
Yeah, I mean, you're seeing companies finding that it's worth it, right? That the company it's accretive to the company, and it's value creating for the investor to keep investing more money. You look at, in a lot of software as a service companies, it's making $40 million in revenue, and their choice is, I could be marginally profitable at $40 million, but only grow 20% next year, or I could burn a lot of cash this year and do $80 million next year. It's almost always worth it to burn the money now, be $80 million the next year, and then maybe be, $100 or $110 million in revenue the next year. There's just a big premium place on that, on being bigger and growing faster, because you earn, not only are you bigger, but you earn a much larger multiple. Partly it's because the interest rate environment is so low, right? You can't earn any money on bonds. So if you're looking at it from the investor perspective, and I don't usually talk finance because I'm actually a product person, but if you look at it from the investor perspective, the yield is so low in almost any other asset class that if you can get pretty reliable high yield from high earnings growth down the road from these high growth companies, that's why all these SaaS companies are trading at 10 times forward revenue. It's a crazy valuation when you look at it facing backwards, but when you look at it as with the alternatives and where you can put money and what return you can get, it actually makes sense.
Sounds like everybody's nodding their heads down there, so you want to comment on that.
Perfect answer. It was a perfect answer. I mean, there's like 5 PhD theses in finance that Sharon just gave ideas to. So hopefully somebody will find them. But having said all of that, what that's given rise to has been this proliferation of secondary investing, because these companies, in this pursuit of high growth and this pursuit of growing more as a private company to then open up into the public markets later, have decided to stay private longer and therefore need some sort of either employee or investor liquidity down the road a little bit, and that's why you've seen the secondary offerings be more prevalent.
But that really kind of shrunk, right? I mean, Facebook was a huge part of the secondary market, but now that Facebook has gone public, is that really what people want to do? What companies want to do? The secondary?
Yeah, I think
market?
you're seeing. Yes,
Yeah.
absolutely. The air was sucked out of the room by Facebook, but
Yeah.
Facebook was one example of many, 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 many other companies who are turning to that as a vehicle to continue to pursue growth underneath the umbrella of being a private company.
Okay, great. Okay, so Catherine, of course.
Sure.
2 changes.
So completely agree with everything that's been said, and there were 2 other things that I just wanted to point out, and this, I think we were going to get to it a little bit later on as well, is just the proliferation of seeds, or especially over the last few years, again. That has just made things really bubbly and really noisy. It's starting, there definitely been fewer seed investments made this year, but there are a lot of seed investments out there. A lot of companies looking for Series A, a lot of companies looking for Series B right now. And then the flip side of that is there's the noise, but then there's a lot of investment opportunities, which means if you focus, you take the time, you get out there, and you really put in the effort to find the good investments, it's actually a good time to be investing, but you really got to focus and put in the time.
Okay, so let me try to recap here. The biggest changes that this panel believes over the last 2 years, the 2 key factors: sizes of funds, there's a polarization, you've got billion-dollar funds, smaller funds, there's focus, there's more stage and sector focus. It's actually quite expensive at the later stages to expand. You have to put more money in there, and globalization makes it competitive. And then there's lots of seed money coming in at the early stages, creating just this emergence of startups. So given that backdrop and these changes, what was your or your firm's philosophy toward investing in your particular stage, say 10 years ago, and how has that changed today given all the changes? And why? Well, let's start with Catherine.
Okay. It's a good question. I think that there are tactics that have changed, but in terms of the actual strategy, I'm not sure that it's changed that much. We look for real companies and real businesses with real revenue models where the entrepreneurs are in it for the long term, where there's a really big market opportunity, where we help them build really big, compelling companies. So, we haven't gotten caught up in the frenzies of the high valuations and the bubbles and the fads and the themes. We've really just tried to be very focused investors. We each have our very specific areas of investment focus that we look at, which enables each individual investor just to say no to a bunch of opportunities because we're deeply focused in our verticals. And over time, we just try to build big companies. And we've had, Rocket Fuel and Rally just over the last 6 months go out, and both of those were results of that philosophy. We're not getting tied up by the high valuations and the trends, but we're just building big companies.
Congrats on those 2 exits. And Maha?
So as venture capitalists, our job is to return money times to our limited partners. And so back in the 2002, 2003 timeframe, 10 years ago, we were looking around and we were saying to ourselves, in order for us to continue to stay in business and perform above the mean and hopefully in the top quartile going forward, we do need to implement a different strategy. And in the 2001-2002 timeframe, it was post-bubble, and we were somewhat happy with taking 12-15% of a company in a Series B. we changed almost whole hog in the 2003-2004 timeframe to really look earlier and stay almost dedicated to that early stage. So about 80% of what we do is in the early stage. That's seed, Series A, and Series B. And we looked around and we said, why are we giving up ownership to this person in the syndicate or that person in the syndicate at later rounds or in the Series A when we could just take the whole Series A, or at least 80% of it, let's say, and get the ownership at a very low cost basis. And then if the company does well, fantastic. We have high ownership at a low cost basis. And we have, hopefully, a very good relationship with the management team that allows us to continue to grow with the company. And again, assuming all of those stars align, at the end of the day, we should end up with a company that has grown into something meaningful, where we as financial investors, as well as venture capitalists, get a nice chunk of liquidity. So it's been more go earlier and be tighter around the syndicate partners and the amount of syndication we want in a deal.
Yes, getting a larger chunk of the
So we've been
company.
greedy. Yeah, I mean, we've been greedy. And that is the rule. And that, by rule, I mean about 50% of what we do. There's certainly other exceptions to that.
Great. Did you want to comment on that? Because that's something good to comment on. Being greedy. Are you greedier today?
I'm sorry, what?
Are you greedier today?
Are we greedy here today?
Yeah, greedy. Because Maha says they've become greedy over the last 10 years.
Yeah, well, I think one of the things that was an interesting time, because you toggled from the 2001, 2002 timeframe where you thought you had to finance a company all the way through to profitability because it was so bleak that you couldn't imagine that there was a follow-on round. And so you ended up seeing, even though pricing was depressed and everybody was depressed, people were depressed, that the round sizes actually got big because you were worried about the ability to syndicate a deal. And one of the things I think we realized at that same time frame is the company's good, someone will want to do a follow-on investment later, but it took a while to come out of the tunnel to see that. I think, just to say something different about Scale VP, we went through a lot of strategy shifts in that period as well, like a lot of firms did. But I would say one of the things that I'm really proud of us changing 2003 to 2013 is we've become a lot more, I should say, humbler about entrepreneurs, because in that I joined the firm in 2001. Between 01 and 03, I think we swapped every CEO in the portfolio. Maybe one or two kept their job, because you really had companies that were going from this trajectory to trying to do this, and you almost, so you had to do a lot of management team swaps. And we were a relatively young firm, and we often, were looking for the experienced CEO to help take the company to the next level. I think now we've become pretty well known for having some of the youngest CEOs take their companies all the way. Aaron Levy, we invested in Box the year the company was in the middle of a $4 million year, right? We had Josh James was the youngest public company CEO when he took Omniture public. Niccolo De Masi, CEO of Glue, was 29 when he took over CEO. So we're often seeing now, we put a lot more emphasis on helping to build the management teams underneath the entrepreneurs than replacing the entrepreneurs, which isn't to say that we don't ever fire somebody or ask them to step down, but there's so much value in the entrepreneurial spark that comes from having the founder be the leader of the company that we've really taken a step back and say, hey, it doesn't have to be, I'm going to say, a guy in a suit, because to be hired is almost always a guy, which is one of my pet peeves. So I think that's just a big change for us around the table when I think about how we talk about our companies.
So I came into to Morgan Thaler in 2007 and was there, started full-time right before the crash of Lehman. So it's been a very interesting time to have joined venture. But our firm has really changed a lot. And I give a huge amount of credit to my partners realizing that change just had to happen to go for the next 40 years, right? So 10 years ago, the firm was heavily investing in categories like systems and chips and semiconductors and all of those things. But we did make a few software and services investments, and lo and behold, that's where we made all our money, right? So they did the analysis, and it was a pretty obvious conclusion in terms of software and services, lightweight, capital efficient models, good, and things that were very capital intensive and very heavyweight with long sales cycles, probably better left to maybe other models. So I give them a huge amount of credit for that. The other thing we have done as a firm over the last 3 to 5 years is be very heavily thesis driven. So as a VC, I'll do between 1 and 3 deals a year, right? That's not a lot. I mean, angels are doing 50 plus oftentimes. And so our winners are all really a product of very intense deep dives that we've done, and that includes, Lending Club, Evernote, Siri, Practice Fusion, and Doximity. And Doximity alone, we looked at 337 companies before picking Doximity, and it was a deep dive in the industry where we touched, that many companies in one way, shape, or form, had a very clear thesis. And what it gets you is when you make the decision, the entrepreneur wants you on the board because you know so much about the space that they're working in and playing in, and you can introduce them to a lot of different people, and you share their vision, right? Because you've gained conviction about what they're doing. So I would say really a shift over to lighter weight, more capital efficient business models, and very thesis driven investing and very focused.
Yeah, and very focused. And for you, you're very methodical. I mean, we've talked many times, and it's you really are patient when it comes to looking for your deal flow. And Maha, not that you're not patient, but you did move to seed. You're doing some seed deals, and that sort of helps you get deal flow. And so I'm curious, there's lots of VCs that are doing a number of different things, but Vinod Khosla has $400 million just specifically for a seed fund, so they can find these companies. So what is the strategy for you? You're kind of like hold and wait. Wait a while, watch them, observe, or maybe not, but what's your seed stage deal flow strategy? Rebecca?
Mine? I just make friends with the angels. That is my seed flow deal strategy. I send them good people. I send them good deals that are before I invest, and I do not compete with them. That's been my strategy. And I take them out to coffee once every 2 to 3 months, and I say, "What's your best deal?" And I look at that.
Okay.
Right, so we absolutely don't do seed. I mean, that was a big part of our, as I said, shift in strategy was, really focus down on what we think we're good at. And similarly, on the thesis-based part is really understanding trends. So, the $400 million for seeds in a way doesn't make sense if even at $500,000 a company, that's 800 companies. So clearly there's not $400 million going in at the seed stage for those companies. But there are thousands of companies that are seed financed every year. So our strategy with respect to that is understand the trends that are inexorable, that are going to create opportunities for startups to get differential scale and long-term market share and profitability, and then focus your effort on cultivating the relationships with the seed stage companies in those markets that you already have a thesis that market is going to create winners. So you're looking early for the early out of the gate seed companies, and you can just lop off a lot of choice space of interesting companies, interesting markets, but not on the big trends that we've chosen to focus on. So that because we have to allocate our time before we're allocating our money.
So we try and take a much different approach to seed investing than what is traditionally called seed investing in the Valley. And to Rebecca's point, we absolutely have relationship with angel investors, and we think that that's an important part of our deal flow. That said, if you hearken back to what I was saying a couple of minutes ago, in the 2003-2004 timeframe, what we said was, gosh, ownership is everything here. And to Sharon's point also, we want to believe in founders. We want these founders to grow with us and develop authentic relationships and trusting relationships with the entrepreneurs that will last, and hopefully last through all of the growth and all of the downturns and all of the growth spurts and all the downturns and all the growth spurts and all the downturns of companies. So having said all of that, we now do about 15 seed deals per fund, and we do them in a different way. We hopefully take the entire seed round, and hopefully we'll put about $2 million, or give or take, into a seed round. So that's enough to get the founder to some meaningful milestone where we can have kind of a natural checkpoint to see if we want to do the Series A or see if we want to go outside and have syndicate for the Series A, but that's been a posture of ours, and it allows us, again, to get equity early at a low-cost basis, whether it's a convertible note or whether it's an equity round that we structure as a seed. So having said all of that, again, we don't do a lot of them. We maybe do 2 a year, and we've been really, really successful at it. So you've seen a couple of companies today who've been seed funded by Canaan, Kuyana, and Blurb. I've probably done more seed investing than anybody in my firm, and I think we've done a really good job of it. Kabam was a seed investment of ours. Kevin Chu is still the CEO. He was an associate in our office. And we most recently had an exit with Versto Software, which was a storage virtualization company, and it was incubated in our office. VMware bought it for $200 million. So we've been doing, our batting average has been doing, we've been good. So it's been a great experience for us, and we'll continue to do it, but in a very different way than what is traditionally called seed investing. It's less of a shotgun approach and more of a rifle.
Hence the percentage of companies that you have invested in the seed stage probably get your follow-on funding and are
Yes.
not left as orphans.
Well,
too.
and it's almost not seed, it's almost more of an incubation strategy, right?
Yeah.
Where you really work with them and get
Very,
them going.
yes,
Yeah.
very thoughtful,
operational
very
strategy owns
handcrafted, right?
a big
And
portion of
again,
them.
we don't leave them to just go away and come back to us every 6 months or so. So that's how we do it, and the companies are inevitably going to change strategies 6 to 10 times during the 6-month period or year period, and that's okay, as long as we believe in the vision of the company and the vision of the founders.
Great. Catherine?
Yeah, so because of the size of our fund, we do not do a lot of seed investing either. Certainly spend a fair bit of time with the folks who are seeding innovation in the stages before us and in the funnel. We will do seed investments on a really, really selective basis. So every once in a while, we will do a sponsored seed, which is exactly what Maha was describing. So Monty Zwieben, his new infrastructure company, was a seed that converted to a follow-on round, and that's what we call the sponsored seed. So we basically do the whole round. We work very closely with them. Typically, we just can't do a lot because we don't have the bandwidth to work with our companies, and our model is to work closely with our companies. And again, on a very selective basis, we will participate, put a small amount of money into a seed round, very selectively. It's got to be following the parameters, though, that we have, that it has to be within a specific area of investment focus. We have to believe it's a really large opportunity. A really compelling entrepreneur, honestly, it's usually an experienced entrepreneur, because at that point in time, we really want them to be set up for success as much as possible. Not to say that inexperienced entrepreneurs can't be successful, but it's often, our seeds have been experienced entrepreneurs. And it's an opportunity for us to have an early look at how the entrepreneur and the company are performing. And to Maha's point as well, ownership matters. We owned 40% of Rocket Fuel before it went public, and that matters when you're trying to return and get a multiple on a fund.
The other thing that's really good about that from the so that's what's all really good about it from the investor perspective, which is great, and then from the entrepreneur's perspective, when you have a seed investor that has a large stake, it's someone who cares, right? So a lot of entrepreneurs get really caught up on, I got $50,000 from each of a whole bunch of big name people in Silicon Valley. And then, it's like the difference between the chicken and the pig, right? You have a lot of chickens were involved in making breakfast, but the pig was really committed. And when somebody invested, not to call you that way.
I know,
Yeah.
I'm greedy.
Yeah, so greedy, that's good. And when somebody invests $2 million in your company and will work to handcraft your company, they're committed and they really want you to be successful. And when they've put $50,000 or $100,000 in, it's just a round-off error, so it doesn't really matter. They're just trying to buy an option on seeing your next round, not actually trying to help you get to the value creation milestones that'll earn you your next round.
So Catherine said 40% ownership in that. I mean, that's amazing.
impressive.
Do you need to have, do you have a hard and set rule in terms of
No. I mean, I think
How
that's
much
one
ownership?
of the reasons why we can participate in a lot of different states. I mean, we only invest in revenue companies, and we have a board seat with each of our companies. So which means we don't do poster deals, secondary deals where we're an inactive, passive tag along with somebody. We do have some companies where we own, approaching 40%. We have invested in companies through secondaries where there's an opportunity also for prime. We really just want to make sure that the company is capitalized for growth. And if that also involves some secondary, that's fine. We're not religious on that.
Well, I want to talk about all across the investment spectrum. It's difficult to choose. I do think that Series A is quite difficult. Not to take anything away from the growth stage, but it's because they're basically a lot of these companies don't have revenue. You don't really have much to go on. Most of them, they may have a good product, and now these Series A investors have to deal with the proliferation of all these new startups. I mean, there's a lot more to choose from, and maybe there's more transparency, so you maybe know a little bit more about them, but it seems to me that it's harder to invest given the glut of companies, or maybe it's easier to invest. Do you think it's harder or easier to be a Series A investor than today versus when you started?
Actually, I think it's harder. I think you have to be very focused. You have to have big macro strategies in mind. I recently went to an incubator and watched a pitch session, and for every single company up there, I could name 3 to 6 other companies doing exactly the same thing. And that, it makes it hard, right? Because it's like, okay, which one doing exactly the same thing is going to win? And so I'm very contrarian. I think every investment I've made, when I've made it, people have made fun of me for about the first 6 months, which is always a good sign in my book. It is hard, and you have to be very focused. You have to really work with the team, and you've got to believe they have sort of a customer acquisition strategy figured out early that can really win, and that's difficult. I think back in 2009, it was a great time to invest, and at that point in time. Yeah, it was great. I was really pushing to do more because there were companies that kind of were making it through that really difficult time period, making hard decisions, and the competition just wasn't as fierce. But as much as there's competition for deals, there's more competition amongst the companies right now between for customers, and that drives the price of acquisition way up.
And these companies are so poised. I was talking to Catherine about this. They're so poised. They're polished. They went to beauty school. The incubators really just show them this is how you walk and talk.
I don't remember a time though where it hasn't been difficult to be a Series A investor. And that said, I mean, we sound like we're whining because we have the money and we're basically passing it out. So it's kind of bullshit that we're whining about it being so hard for us. But having said all of that. It's always been difficult for one reason or another, whether it's the macro issues associated with a certain vertical or whether it's the issues that Rebecca's talking about with the proliferation of companies in a variety of sectors. So I don't think that's going to change. What's important from our perspective, and I'm going to speak as a group, is that we're investing in companies that we think are powering into very, very large markets at what we believe is going to be the right time. And if that's the case, then we're going to find the best company, the best team, the best product to get you there. And as early stage investors, 9 times out of 10, we're going to be wrong. But hopefully that 1 out of 10 makes it into something huge.
Yeah, I think that when you look at the venture capital business, there's just different risks that investors are willing to take on and be rewarded for at different stages. So and you have in the very early stage, it's can you build this? Then it's will people do this? Will people pay for this? Then it switches to more operational. Can you scale it? And then are we paying the right price for it? Like you see a lot of late stage investing in pre-IPO pricing actually, has a ton of pricing risk where companies actually go public below the last round price and then have to try and grow back into making a return. And so it sort of speaks to the firm, what kind of risk are you willing to take and what kind of entrepreneur and what kind of proof points are you looking for on the other side, that makes a match. And I think, when people do things that are unnatural for them, a firm that's typically late stage does an early stage or vice versa, you end up seeing a kind of gear grind there, and that's why this trend toward focus has happened. It just specialization happens in evolved societies, and venture capital is now, in its the 40th year or so.
Yeah. I think the one thing that I'd add to that is that I think it's a lot of hard work. You have to put in a lot of time, and you really have to focus, especially these days. I think it's really critically important. And the one thing we haven't touched on too much, we talked a lot about the front end of the funnel and then scaling the companies, but actually not only managing the companies, but managing a portfolio. That's a lot of work, and you've got to be on that regularly, and that's a lot of the behind-the-scenes work that the entrepreneurs don't see, and you have to be really rigorous and make really hard calls, but the important and right calls.
Okay, so we're pretty much out of time, I believe, right? So
17 seconds.
Unfortunately, but I have two questions, so I'm going to make them answer them really quickly because I can't, I can't not talk about, all these funding platforms. And so, and they've emerged, and now you're seeing that they really are helping to bring a lot of these deals together, bring new money to these startups. So, are they good? Will you work with them? Oh, of course you're going to say they're good, but how will you work with them in like one sentence?
Yeah, I mean, I see them as another channel
Yeah.
strategy and channel partner.
Same.
Same. Okay, and then future trends. What are the two trends you're investing in, and what's exciting?
I mean, definitely mobile. And I continue to look closely at healthcare IT. So, we had the High Tech Act roll in, the Affordable Care Act. I have a 3-month-old at home, so I'm a little sleep deprived. I apologize. Affordable Care Act roll in, and now we have insurance exchanges that hit. Obamacare just rolled. I think there was a lot of things happening, and you really have to understand the mechanics of how money's moving in that space and how incentives are changing. And so we continue to look pretty heavily in that area. It's not the only or sector we invest in, but I probably will do at least one more deal in this fund.
Okay, Sharon?
Yeah, I think the space where the last few deals that we've done have been all around sort of, a completely new computing architecture when you look at sort of the combined trends of cloud, mobile, and real time. It changes the infrastructure under almost everything that software is touching, and so there's just a lot of infrastructure investment opportunity right now.
That's right. Virtualization has transformed the data center and how compute happens and at what price compute and storage happens. And that has led to the proliferation of enterprise companies as well as consumer companies able to do what they do at a much lower starting off price. So we are heavy into data center automations and virtualization companies.
One of the key themes that we're currently looking at is the area of business process reinvention applied to different verticals. So whether that be education or health or whatever it may be, infrastructure, that whole general theme of business process reinvention, because we believe that just all areas of businesses, all areas of the stack are up for grabs right now. A few areas that I'm looking at specifically is business process reinvention to the retail and commerce vertical, labor innovation, so how labor is being deployed in various ways, how it's being optimized and automated, and then an area that I'm calling life tech, so how our individual lives as consumers are becoming optimized and automated.
Excellent. Well, Affordable Hair Act, that's the best
Yes.
one here. You heard it here first. So thank you, ladies. I'm sure they're going to be here. Catherine, Maha, Sharon, and Rebecca.